I have the pleasure of introducing our keynote speaker, Timothy Barrett. Timothy Barrett is the President and Chief Executive Officer of the Federal Home Loan Bank of Boston. With more than 35 years of experience in the financial services industry, Timothy J. Barrett assumed the role of President and Chief Executive Officer of the Federal Home Loan Bank of Boston on December 1st, 2021. Tim joined the Federal Home Loan Bank of Boston in 2010 as Senior Vice President, Treasurer, and was promoted to Executive Vice President in 2019. As Treasurer, Tim was responsible for the overall management of the Federal Home Loan Bank Boston's balance sheet and oversaw areas that included member product pricing, investments, debt issuance, liquidity, hedging, and market risk management. During his tenure, he has served on various Federal Home Loan Bank Boston committees, providing invaluable guidance by leveraging his expertise, insight, and collaborative approach. Those committees include the Management Committee, ALCO, Bank Technology Group, Business Committee, Thrift BIP Investment Committee, and Credit Committee. He has also served on the Federal Home Loan Bank System's Financial Officers Group and the Mortgage Partnership Finance Governing Council. Tim has also stepped in to manage the Federal Home Loan Bank Boston's bank operations in addition to his regular responsibilities on an interim basis. Prior to joining the Federal Home Loan Bank Boston, Tim was Assistant Treasurer at FMR LLC, a Boston-based multinational financial services corporation. Throughout his distinguished career, he has held executive positions at several New England banks, including Shawmut Bank, Fleet Boston Financial, and Investors Bank and Trust. After graduating with a Bachelor of Arts degree from St. Anselm College in New Hampshire, Tim began his professional career as an investment manager with Citibank. He earned an MBA in finance from Rensselaer Polytech Institution while serving as a portfolio manager at Shawmut Bank. Tim also serves on the advisory council of Bridge Over Troubled Waters, a Boston-based organization that serves homeless and high-risk youth. Please join me in welcoming Tim.
Good morning. Thank you for that. You probably provided that long list. We could have just said my name and that would have been fine. So I'm very happy to be here. I'm very happy to learn more about the cooperative, but also we're all, there's another cooperative in town, it's the Home Loan Bank of Boston, and I know a lot of us know about us and our members. It's important to us to make sure that we understand what's going on as well. I was going out into the hallway, and one of my colleagues was here, Savas. Savas is here on his own. We should be planning these things, but it was good to show that having a connection with the credit unions is important. Savas is part of our relationship management team. I'm glad he's here, and we'll both learn a little bit more. So I have about 30 minutes. I have some slides. I'd rather hear questions, so I'm going to probably go through these somewhat quick and then leave some time for questions. And I don't think I'll approach it the way Mike did and try to come at you at the back of the room, but I think there's a lot of things I just heard are relevant to what we can do at the Home Loan Bank. So some of this is just going to be, hey, this is what we do, this is how you can engage. But when I looked at that list of important things that you folks are thinking about and are dealing with, the Home Loan Bank could fit into some of those issues, and maybe we can help out. I have no idea how to get to some teenagers with phones, okay? I have 4 kids and some grandkids. I have no idea how that's going to work, so I'm not here to tell you about that. So, again, talk a little bit about the bank, talk about our membership, talk about you, things that you probably know, and some economic trends. I know everybody wants to talk about what's going on with the environment. We spend a lot of time thinking about that. We don't have any answers either. So overall, we always start with the mission. What do we do? We're a liquidity provider, but we're also a funder. There's a difference. We have financial products and services. A key, when I got here, one of the big aha moments was what we do for affordable housing, community development, and programs that target low-income households. It's in our culture. It's part that some of it gets mandated by the regs, but you'll hear about our programs that we do voluntarily. So we're here to support New England. So Bank of Boston, Federal Home Loan Bank of Boston is a New England institution. We really have a diverse membership, but we really hit home on the smaller communities. We're also a shock absorber for when things are bad. It's interesting, I've been around when Volcker started raising rates, but I lived through a lot of liquidity crises. At banks, I saw it on Wall Street. It's not a good situation to be in. But since I've been at the bank, one thing the Home Loan Bank does is we engage when things happen, when bad things are happening. You look at our track record of advances, they start going up when things get bad. So 2008, the COVID crisis, this interest rate change, this pivot, we're seeing more activity. So I don't know if that's counter-cyclical or it really is part of our mandate. And we have a diverse membership in that, banks, community banks, insurance companies, credit unions. And I'll show you some of the numbers. And what we try to do is talk to them, understand what's going on in their communities, but also help them provide support in these communities that really need it. So a little bit on this will be quick. I think most folks here know, but it's good to remember. So we're a lender. We have on-balance sheet lending. We have letter of credit facilities. We have a variety of products. When I say we're a liquidity provider, yes, we are, but also asset and liability. We provide funding across the curve in different types of structures. So keep that in mind. It's not just when you need it in a crisis. We spend a lot of time thinking about this. We talk to our members at different levels of the bank. We have folks that are really smart. And in our website, you'll see thoughtful work is done on current issues. Interest rates flat for 20 years or pivoting. These are the type of things you should think about. We have that on our website. Take a look at it. Mortgage partnership finance, again, formal liquidity. We buy loans from our members. There's skin in the game for the members. We trade off risk. It's a solid way of banks to continue lending in the market. This market today is different than the market was just 2 years ago. But keep that in mind. I heard some things about potentially selling portfolio loans. We tend to see flow business, but we're also getting phone calls or have gotten phone calls for what I'll call bulk sales. I know the timing's not great right now, but again, think about that in terms of what the Home Loan Bank can do. And then correspondent services. One of the things that we spent a lot of money on recently and we continue to think about is ease of use for the members. So we have an online banking portal. We're trying to make it as easy as possible to borrow from us. Now, we're not leading edge of technology, but we've spent enough time thinking about what really works. And our online banking platform, we're going to spend a little bit more time on that. But we think it's a value added for our members. Again, housing community investment is important. We have various programs. Some are geared to affordable housing only, but community development, equity builder, helping folks get in their houses by providing down payment assistance. These programs are pretty much, you'll see these across the country. All the 11 banks have these types of programs. Where we get unique in New England and other regions as well is what we call our voluntary programs. That's really where the rubber hits the road, where our team's out there talking to communities and what they need. Housing our workforce, before the labor market got out of control, there was a lot of people out of work. So housing our workforce was one of our programs where we give down payment assistance in that 80-120 median income. Jobs for New England. Again, it was at a different time, but we're still getting a lot of demand for jobs for New England. So it's an advance. It helps preserve and create jobs. And now we're recently rolling out in this year, after working on it for about a year and a half, is a special purpose credit program. What that is, it's targeted. The Home Loan Bank believes in everybody gets a shot. All our programs are competitively based, but this one in particular is to target borrowers of color. So very unique for us. And there's been a lot of work on fair lending and making sure that we can do this. It's been through the meat grinder quite a bit with our examiners, but we hope this will work and hope it'll hit again what we think is a challenging New England. Real quick on our membership, yes, we're diverse by 425. Credit unions are a big part of it, 37%. There's a lot of talk about large commercial banks, which is 12%. New England doesn't, maybe good or bad, doesn't really have those big mammoth banks anymore. And then insurance companies have been members since day one. They've only started showing up since the financial crisis, and I wonder why. Liquidity becomes a very important part of all industries. Give you an idea of some history here. Again, advances are where we lend on balance sheet. MPF is where we buy loans. Prior to the pandemic, pretty healthy, and if I went back another 5 years, you'd see the same. And then it came down during the pandemic, and then we're on an uptick now. What I'll say is, this is how we're built. This is not a financial concern for us. We're set up where we get larger when demand comes in, 2008. We get smaller when banks and credit unions have high deposits. That's what happened the last couple of years. So we went down as low as $12 billion. Now, talk about not sleeping at night, there was a lot of that going on, but we were in good shape, financially sound, a lot of capital, but the business was slow. Last year, we had an uptick probably about second quarter, and we've continued that well into this year. So that's your activity. That's what's happening with the credit unions. We're seeing that we're engaging. And ask me if that's going to continue. I'll ask you, is that going to continue? It just seems that we're seeing activity. Just important to give a sense for our affordable housing, because we're very proud of it. There's the program itself. Again, that's statutory. We have to 10% of our earnings gets put out into the market in these programs, and then voluntary. You can see in 18, 19, voluntary were higher, and then most recently higher again. So we'll do what we can do. Even in COVID, I'll point out that we're still doing our voluntary programs. The need was there. We had current earnings. It was important to the bank, but important to our board and important to our shareholders that we do that. Now, I don't have to tell you this, I'm going to go by fast, but we're watching and we think about what your trends are. Obviously, auto loan business, home equity loan business, consumer, I heard consumer business, resi business. It's been upward movement. Now, these are, third quarter last year. We know what's going on with rates and how that's going to impact that, but we continue to watch and stay informed as to what's happening with the credit union, in the credit union business. Deposits have been the big story over the last year. Deposit outflows. It may be hard to read, but basically what this shows is that we're seeing, like other members, we're seeing money start to move. That's the big challenge for balance sheet management liquidity. Movement of money. Where is it going? The big block there is that the deposit out contractions from 0 to -2.5. So to the left, it's greater, out to 5%. to the right is actually growth. So there's still some growth, but I think that's the story of the last year. Money's moving, hot money left, rates are higher, consumers are more discerning. We'll talk about the Fed. The Fed is pulling back. So this transition is epic. This has not happened before. Even if you go back in history, I have gray hair and I was around in '81. This is a very different time in that way. It's epic because of where we came out of. So economically, from the Fed, so this is an opinion. My view is the Federal Reserve has seen enough about deflation. They never knew how to really fight it. So 20 years of excess liquidity for a lot of good reasons, I guess, and deflation scared the heck out of them. They tried to inflate. They couldn't inflate. They tried their hardest to get the inflation rate up. Couldn't do it. Mike and I talked about Japan. For how many years they tried to do this? They couldn't do it. So unfortunately, we have a pandemic. And after the pandemic, and if I was to bet you what would happen after a pandemic, I don't think anybody would get that housing prices went where they were. I mean, there's no way. I mean, anybody who really called that, I think probably didn't really tell you the truth. I just didn't see that happening. So what's happening now with the Fed is that there is inflation. There's two mandates, economy and inflation. It's there, and they're going to fight it. And my view is the way they're doing it is, again, epic. The graphs of prior increases of rates, the path up seems to be pretty long and measured. The path now is hockey stick. It's very dramatic. And the market will talk about what's going on next, what's happening. My opinion is the Fed will continue to do this, and they may break things, but they are intent to kill inflation. My opinion is the market's expecting a quick turnaround in inflation. I just don't see it. It could be a higher rate. It doesn't have to be a higher rate. Like, I'm not necessarily saying rates are going to go up any, much more, but they're going to keep fighting it. And I think right now, their goal of 2%, that's probably a goal that they're not going to stay with. I think they're going to allow inflation to be higher. So my guess is that there may be a target rate that's north of 2%. But the point I'm making is this transition of higher rates, I think, and what we're thinking about at the bank, is it could go longer. It's the yield curve and what people are talking about just seems that, for 20 years, it's kind of nice to have liquidity. It's kind of nice to have easy money. It's kind of nice to have rates down. And people think that's a normal thing. And investors do, the stock market does. So I think the longer it stays there, I don't think the Fed's going to bail early. I don't think that's not what they're going to do here. And I also think that the Fed felt like they were in a precarious situation for those 20 years. They were embedded everywhere in the market. And I think they're trying to get back to what their role was and what their mandate is. So that's a lot of opinion. I'm not saying that's the Home Loan Bank's opinion, but that's mine. So I mentioned the yield curve. And, again, if you look at the market's always, you always keep an eye on the market and what it's pricing in. Inverted yield curve, to me, prices in rates up, rates down. So that's been there for a long period of time. I just think it's going to get pushed out when reality hits. Okay. So I think we're all in tune here, but, economic growth, employment rate, any inflation indicators, keep an eye on those. That's obviously our business, but also they'll give you a sense of what's happening. Home price appreciation, with higher rates, we should be seeing some, lower priced housing to make affordability easier on our consumers. It's not happening as fast. That supply-demand dynamic is really support, maybe higher or stable prices. It won't go down as fast. And I'm with whoever said it, 6%, boy, that sounds like a lot from 2%. But boy, that's really still a long historical rate. It just is. And a couple of graphics just to hit home on the point. Home prices, this is CPI based. This is a lagging number. So CPI, when we hear about CPI, over the next couple of months, they feel like it's higher than what's going on around us, and then it'll come down because there's a lag there. And that's why this is from a different source, and you can see that prices are falling sharply. It's pockets of sharpness. I don't know if that's overall, depending on where you live. Some areas that really ran up fast are probably coming down, but some areas probably aren't. Depending on the community, are probably not moving as much. This should happen. Rates higher, this should happen. Available loans for sale. This is the big story, I think, for COVID. A lot of buyers, not a lot of sellers, not a lot of supply. It's changing a little bit. And again, another pricing graphic around Boston. It's expensive. Homes are expensive. Rates are higher. It's making it much more expensive to live. Unemployment, very interesting dynamic during COVID. It scared me when I saw these kind of spikes and folks that really were living paycheck to paycheck, and companies cut their variable costs really fast. The good news is that it's come back down. In higher rates and recession, when unemployment is so low, that's different. It's different. We're hearing about companies laying off, but I think they're laying off what they're probably overhired, not maybe their revenues are getting cut. So this is another different thing that just, and I'm not an economist, I may sound like one, but I'm not an economist. This is interesting to me. Does this mean, can you have a recession and have 4% unemployment? People are working. Now, someone said it also, personal bankruptcies, a lot of the stimulus money is going out the door. That's where, we'll see our consumer, whether they're really, working, their wages are better. Coming out of COVID, jobs, wages, wealth, however you measure that, is better. The question will be over the next year. I've got one more slide. No. So this is our market here. Again, historically, it's pretty low. There was a lot of talk during COVID, 2 years into COVID, people leaving their jobs, and a lot of folks just, for a lot of reasons, and I can't tell you exactly what they are, but it seems to me that we're in pretty good shape right now in terms of that a lot more people are looking to hire than not. Now that could change again. That's going to change over time. Right now it's pretty good. That's good. So I really ran fast, but I'm going to give myself 5 minutes. Any questions? Yep.
Tim, I was wondering if you could speak to, so the FHLB has pretty strict adherence to the prepayment penalty, and I was wondering if you could speak to maybe the matching or the sourcing of your funds. I understand you issue debt securities as a big portion of sourcing your funds when you borrow from it. Can you help add some flavor as to why there's such strict adherence to the prepayment? It's like 90+% of the interest that we would owe in long term if we prepay it.
Well, we need to charge by statute a prepayment penalty. We do have some. We have to do that. We do have some advances, floating rate advances, that when you calculate the prepayment penalty, it really becomes, not a factor in that. So unfortunately, we can't waive that. It's not a matter of waiving it. But when you say 90% of the rate, really what it comes down to is basically it's a make whole for the bank. If someone bank takes out a 5-year loan and prepays in year 1, there's 4 years of present value, that gets kicked into that. Yeah, it's, I'm a banker. I came in here, I couldn't believe it. I was like, we're charging people prepayment penalties. Now we do have some products that, not you can get around that, but the cost isn't that high. Some are derivative based, some are just floaters.
And just to add on to that, I I always assume that there must be a matching process that you guys are going through. You're trying to match your funds to the borrowings as close as possible, so you're still stuck with that as well, even though we prepay it. Is that an accurate assumption?
Yeah. So, I mean, predominantly the bank is run on a match-funded basis. So 5-year advance, we go to the market and we issue 5-year. We have deposits, but they're not really funded deposits. They're not funded, reliable deposits for funding. So we work on a match-funded and interest rate matched as well. So we do use derivatives to match that interest rate differential. But yes, if we lend 5 years, and we're going to borrow 5 years, that's the goal, because we don't want to have a lot. So if there's a prepayment, that's really where it's coming from, is that we have to redeploy that funding.
Thank you.
What is the makeup of your board and how are directors selected?
So the board is membered, there are, the number today is, let's say there's, I want to say there's like 14. So we have member directors, and they vote on by the banks, by the members. I'd say banks, by the members, membership. And there's independent directors that are voted on. The directors select the independents based on the criteria of what we're looking for, accounting, risk, and they are voted on by the board.
Do your bylaws allow segregating by some of the interest groups that you have? You've got banks, you've got credit unions, you've got insurance companies. Do the insurance companies have a guaranteed number of seats on
No.
the bylaws?
No, it's member driven. So historically, so far, since I've been there, and I think going back, we haven't had a member from insurance companies. Actually, the credit unions, I've been there 10 years, I'm going to be on my 13th year. I do not believe, well, we did have one credit union board member. But no, there's no designation, there's no allocation based on the sector.
Seems to me that that's an issue. But that's an issue if you're trying to, track credit unions, credit unions to work with the Federal Home Loan Bank. If the answer when you have your annual election, the answer is well, banks say that you just don't qualify. Would seem to be that.
Yeah, and it's I can provide more information on the details, but it's based on shares in a sense, the ownership. So I think historically the banks have been more engaged with it. They're lobbying for those positions is all I can see. But there's nothing prohibiting credit unions. Any other questions? So a couple of folks have said, I'll just bring it up, that one of the topics that we see through all our members, and credit unions especially, I've heard some more questions about, is the tangible net capital question. Obviously balance sheets have changed, rates are going up, mark-to-markets have increased. We have, it's again statutory that if tangible capital as a measure of creditworthiness goes negative, then we cannot lend. Well, really what that means is that we have to have a discussion with the members' prudential regulator and basically say, is it okay to lend? There's a step there. We've been dealing with the FHFA, our regulator, probably since this all started hitting the fan, I want to say early December, late November, when September numbers came out. And they have been talking to their other prudential regulators. And as I sit here right now, there's no resolution. And honestly, if I was to bet on it, I'd say there's not going to be a resolution. And the reason is, the FHFA, for some reason, doesn't want to waive it. Now, from the bank's perspective, it's a measurement that we look at. It's not a measurement that we really consider as a factor in lending. We have a whole slew of things that we look at. And I can sit here right now and tell you there's no members are near negative, no credit unions. And I heard earlier that I want to say about 30, 35 members nationwide are kind of working with it. And some of the reasons our rates have gone up quite a bit and come back down. So there's some relief there. So fourth quarter numbers could change that. But unfortunately, we're not getting much relief. So at the bank, and I urge you to talk to SAVA and relationship managers, or to us. We're trying to work with the credit unions and the banks, especially around collateral. That's our purview. Some of the things that we would have to ask for is, more collateral, not more collateral, but bringing collateral in, and really creating kind of an operational headache for the credit unions and the banks. So we've worked that out a little bit. Where if any entity, any member is getting close or making phone calls, we don't want to be in a position we can't lend. Now, if there's a credit issue, then that's a different type of lending, and we're still out there and we're still working to help out. We don't want to be in a situation of causing a problem. And unfortunately, this is a regulatory issue that we can't seem to get them to at this point. So not good news there, but if it was on your mind, I was going to make sure that we talk about it. Okay. Send us questions, Sava. Glad to take questions. Look at our website. It seems like you guys, there's a lot going on here. There's a lot of environmental things going on here. And we're here, we're thinking about the same thing. We got a balance sheet, we're thinking about the same thing. So, and again, you guys own this. It's a partnership, it's cooperative. Good.
Thank you, Tim.
Okay.
Thank you.